Good evening. Ira Epstein with your Metal Market Wrap-Up, and this wrap-up is for Thursday, the 24th of August, 2023. The time right now, just getting on to 5:57 p.m. Central Time. Now, I backed away intentionally from making a lot of new trade recommendations starting yesterday. Came out of some of the marketplaces for my paid subscribers, which brings me to this. I have a lot of paid subscribers, obviously. That's how we're able to do this. I get questions, the cost. I don't want it to be too much. Frankly, folks, it isn't. I mean, give you an example, the $7.95 intro rate on the futures, you're getting 24 videos a month, each about 15 minutes long. You think that's expensive? And then it goes to $15. But what we are coming up with for the Labor Day is a special. So be ready for it. You'll hear me talking about it. It's only going to be up a few days. Get your dollars ready. All right. So let's talk about the markets. Number one, I wrote tonight the importance of tomorrow's speech by Fed Chair Powell. I consider tomorrow to be the equivalent of an FOMC meeting, a big one, because it sets the tone until the next Jackson Hole meeting. Now, the last meeting that we had was what? We had that the Fed was going to attack the inflation problem and tame it down, which it has done. It has taken headline inflation from 9% to about 3 and a fraction, right? Where it hasn't been able to take things down is in the core by anywhere near the same amount. Now it's very sticky. It hasn't been able to take shelter costs down very much. There's not much around. Higher interest rates are creating a problem with that. And now the question is for the Fed, how does it finish the project? What we've got still is 3.5% unemployment. It's nowhere near what the Fed thought it would be going to 4.5%. We haven't seen weakening in it. Today, if you took a look at the unemployment claims, they didn't come in weak. But I'll get into more of this as we get into the other updates. Suffice to say, the dollar index came back as the market anticipates the Fed chair is going to hold the pattern and say that the battle's not over, they're going to continue. The question is, the battle not being over, do they say come September that the data says to pause and leave the options for each meeting to be in live meeting? And if inflation doesn't slip enough, or God forbid, it picks itself up a little bit, do they go back in and raise rates? That's really what you've got. If you think in any manner that this type of environment is worthy of a rate cut, you are sadly wrong. Could something happen that I don't know about, September, October, November, or December? Sure. Could something in the world change dramatically? Yeah. But listen to that key description. Change dramatically. Not little bitty things. It's got to be something dramatic. What it is, it's a catastrophe. What that is, I don't know. Do I expect it? I do not. You shouldn't live thinking that's what's going to happen. Therefore, he, being the Fed chair, is caught. Tomorrow's a huge speech. Don't underestimate it. Then I was looking today and last night at NVIDIA and I'm watching people jump on it, and I'm going, this is a disaster about to happen. I think I'm the only person in America saying that. Everybody, you got to own NVIDIA, it's going to go. I am not bearish on the company, not in the least bearish on the company. But I would never tell a client to buy over a Bollinger Band. And those that did, paying $515, $17 last night in the aftermarket, it's back to $471 under the Bollinger Band. So when I look at the gold market, gold's problem is a strong dollar and a Fed that is determined to beat down inflation. Why do I want to own gold? That's the first darn thing that bothers me about it from a fundamental point of view. From a charting point of view, a little different. The market had been in a consistent decline. It went here from the 2030 area all the way down just over the 1920s and has gotten itself a bounce. Okay, I can live with that. The pattern on the swing line is that of a lower low and a higher high. What would I define that as being? Friendly or not? No, it's nothing. It's not a trend. You broke the downtrend when you took out this arrow's high. And this is a reaction to a market that got pulled down and you let go of it like a rubber band and it sprung back up. That's basically what I think the chart action is like. More short covering than anything else, I think, is what's going on. Where did the market stop? Right where I tell you that line in the sand. Chart technicians like points on a chart, they can go, oh, look, that's a resistance, that's a support point. Well, anybody can say, oh, that's this, that's that. Well, what is that? But when you get a moving average, it's always, by the way, moving averages don't tell you where you're going. They're backward looking, not forward looking. First thing to understand. Second thing, when you're well under one, it's not uncommon that if you get a hard rally and you go up to what I call the key, which is the 18-day average on every chart, that is the one that often stops the market. Could it be a 200-day, a 50, a 100? Of course it could be. But more times than not, after a big move, it's the 18-day average that you go to. And from there, the market goes, what do I do next? Are we trending here? You are not. You have a lower low, higher high. The bias is down. You're under that number, but you're right at the resistance point. Let's assume the market decides to move higher. Another layer of resistance is the 100-day average. After that, the Bollinger Band, and then all the way here. I take that back. This is the 200. I guess I'm colorblind. That's great. That's the 200-day average. That would be the next one. What about momentum? When you lose the embedded reading, in other words, when the market, which has been underneath 20 all this time, comes back and finally gets over that number, 21, I often tell you the market's probably headed to one of the main moving averages. That's exactly what occurred. Not going to occur, it did it. Next, I look at the ratio of gold to silver. Silver's been on a tear. I mean, it's unbelievable how much stronger silver got than the gold market. And you see this. This market went from 84 back to 79 in a straight line down, and you see it in silver. Do I know why? I don't have the slightest idea. Do I know that when you lost the embedded reading, I thought you were going to go at least to the 18-day average of closes you did? Then, just like I told you in gold, where the other layers of resistance are. If it keeps going, because you've got the 200-day average here, that's the next resistance point. After that, the 100 and the Bollinger Band. Do I think there's much left here? No. I think the market has spent itself. It's all the way back to where the break began from. But unbelievable action, probably a lot of it due to thinness in the market in the month of August. In the copper market, we are right up to the resistance. Again, you lost the bearish embedded reading right through here, got that reading over 21, got it right in this area, went right to those averages. Resistance all layered above the market. I call this markets that have gone neutral in front of the Fed meeting. I mean, when you look back at it and you try to make things work out, that seems to be it. Why? I couldn't begin to tell you, nor do I care. It's just what the market did. You don't have to have reasons for everything. You have to, as a chartist, recognize what's going on. The same thing happened here. And all the reasons to not be short. So the beauty is, by using these simple things and employing them in your trade, what you're trying to do, and I want to use that word key, trying to do is avoid getting hurt. That's the key. Will you have losses when you make some of these trades? Will you be a little late? Could you be late? Yes. Is it often? No. But it's going to happen. And like here, I am bullish the dollar index. Until this closes under 79, why would I be anything but? However, I told you, I told my clients, I don't want to be in the market. And I told them yesterday to come out of the market against the Bollinger Band in the subscription video. Why? I don't want to go through the FOMC meeting. Could I be any clearer? I use major reports, and there's plenty of them, to walk away. Markets will tell you what is a major report. You'll get all the press, all the fanfare, and they'll go, oh, this is going to be a big one. You just read. It tells you. They'll explain why, and I go, why do I want to go through that? And I walk away and come back. Trading is different than investing. Understand it. Don't make a bad trade become an investment. I watch Kramer all the time. He's famous for that. He'll get in something, this is such a good company, I want to keep buying it. And a year later, he's got a problem. His problem is they tried to get a fund to follow him. They couldn't even do it. Not that he's not good or bad. That philosophy, if you're going to be an investor, not a trader, that's what he's got to say. Then it makes sense. Hey, I looked at the chart. This was good. It didn't work out, but I still love the company. I'm going to hold it. Futures will kill you doing that. 90% leverage? No, you cannot employ that tactic. That's where I want to leave things tonight. You have yourself a great evening. Again, 9 o'clock in the morning, the Fed chair talks. You know I'm going to be glued to my chair. I've already told my subscribers to my morning ETF, it's going to come out later, probably an hour later. I want to see the Fed chair talk. I want to see how the market reacts to what he's saying, and then I'll put out that video. The futures video I put out at 5:15 in the morning, so I'm not going to wait for that one. You have a good day. Take care.